In this next video presentation, I want to give to you a little bonus. I want to show you exactly what some of the plays are that the market makers or the big money guys do to us to try to take our money. Once you understand these, you can prevent yourself from, one, losing money to them, and two, allow yourself to actually make money when you trade in line with them. Now, identifying the weekly structure is as follows. What we're doing is we're looking from an hourly chart, and we're taking a look back at activity for the last 3 to 5 days to determine what the trend has been. Okay, now here we have it playing out on the chart. Notice here that the high was set here, and we have 1, 2, 3, 4, basically 5 days of directional trend or drop, followed by a midweek reversal with 1, 2, 3, 4 days of rise. These are prime candidates to identifying what our weekly structure should look like. Now this pattern plays out in futures, it plays out in commodities, stocks, precious metals, or even chickens. Let me show you how you can benefit further. Let's take a look at our next slide. In this example, we see the opposite side. The low of the week was set here. We had rise on 1, 2, 3, 4, basically 5 days. We had a retest of the high here on day number 6, followed by 1, 2, 3, 4 days of drop. Again, this is the weekly structure. These are ideal setups that the market makers use for us or against us. Once we can recognize these, we're going to be able to profit from them. Here is an example of a chart that we would not want to trade. It's basically, taking a look at it, it's all over the board. It's up, it's down, it's spiking to the top, spiking to the bottom. In a case like this, when we come to the terminal and see this, this is definitely something that we would be passing on. We're not interested at this point in trading pairs that are behaving this way. Once again, here's an example of a chart that we're interested in trading. We see the low was set here, it had a nice day of rise, had a little bit of a retracement back to the 200 EMA, and then it had several more days of rise, hitting our high of the week here. It retested on Friday, and then it went short. Basically 1, 2, 3, 4 days it fell short. These are ideal setups that we should easily be able to identify. Let's take a look at gold. We can once again identify this pattern, this weekly structure on gold. We had a couple of down days here, followed by 1, 2, 3, 4, basically 4 days of rise. It came out, set the high of the week here, pulled away from it, gave us a nice retest, and then price changed direction here. Here's another example of this play playing out in the S&P 500. We can see back here that the high of the week was set here. We've had 1, 2, 3, 4 days of drop. Here's our midweek reversal, followed by 1, 2, 3 days of rise. Next, we're going to look at the Nikkei. And again, the same chart, the same pattern we see play out here. This is the weekly structure. When we're able to identify this weekly structure, we're able to take advantage of the trades that are available to us. Here's the consolidation zone, and then we can see a little bit of a stop hunt here. Long sustained run. We have 1, 2, 3 days of drop. Price pulled off the low, came back the next day, retested the low. So here's basically a double bottom here, and then we had several days of rise. These are the exact patterns that we're looking to identify. These are the best trades that are offered in the market when we can identify this pattern here, or play number 1. So once again, we are looking for pairs with this specific pattern. This is the play that the market makers use in play 1. It's called the weekly structure. Several days of rise, followed by a peak or a reversal point, and then they change direction and they pull price the opposite way. 1, 2, 3, in this case, 4 days of drop.
I just quickly want to add that this play 1, the weekly structure, is a principle. It is principle based. Whether it's in the Forex market, whether it's in precious metals, whether it's in commodities, stocks, or even chickens, this is a principle. This is a principle play that they use to get your money. Now, you might be wondering, who cares? If I can recognize what they've done, they went up, then they went down, who cares? If you're asking yourself that, you're about to find out. because knowing their moves, knowing their plays, allows us to predict what's coming next.
Just want to add that this is play one for a reason. This is play one because it's looked at on a macro basis. We're looking at these moves over a larger period of time than we're going to be looking at them for entry purposes. We want to form a bias for the market before we ever consider entering. That's why we look at play number one. That's why it is play number one.
Okay, so the first step is actually identifying how play number one pans out or paints out on the chart. The next thing we need to be able to do is actually project the next move or the next trade, as Kanan mentioned. Therefore, step number two of play number one would be projecting the weekly structure. We can see here on the Australian US dollar that it was trending up here. It set the high of the week here on this Friday. Monday it came back, retested this high, and we had a couple of down trades, followed by some consolidation, and it eventually towards the end of the week made its way back up to this high of the week. We anticipated that this pair would gap up, consolidate, give us that stop hunt, begin the long sustained run. Now, being able to project this gives us the competitive edge because we know where they're taking the market. When price does come up here, consolidate, we set our strike zone up here at the stop hunt. We're simply waiting for price and the candle pattern to paint before we actually take this entry. It's very, very predictable, and if we're on our game and we understand the cycle, we're going to greatly benefit from this. Now, I want to make it clear to you, as you can see here on this chart, these lines were penciled in on the 16th of August. We had no other candles. This was on a Friday evening that we did this in our sessions. Our Friday night sessions, we do this every Friday night. We evaluate the market. We pencil in the projected moves. We come in on Tuesday, take a look, and for this particular month, the month of August, we were 100% correct on every single pair. Why is that? It's because we understand the market, we understand these cycles, and we're able to take that understanding, project it out on the chart, and take advantage of these moves. Here's exactly what happened. This particular pair came out, it consolidated here, gave us a nice stop hunt to the top side. This is where our strike zone was set at this retest here, and had a nice long sustained run down. Now, in keeping with our daily cycle, we can see that there was opportunity here and here to add on to our position or to jump in at the continuation of the move. We could see here on day two it bottomed out and it reversed back up. So our next strike zone would have been set here had we been trading on the hourly. Okay, next pair, we're going to take a look at Euro Australian dollar. High of the week was set back here on Wednesday. We had several days of drop. It gave us the low here Friday, retested into Monday. Late in the New York session, it gave us another test before price actually pulled away. Consolidated for a couple of days. On Thursday, it decided to come back and hit this low of the week. This would have been a great opportunity to take it long. Now, on our Friday night session, here's what we looked at. We saw that price had moved back up, and Friday was working its way back down towards this low. Wasn't quite there. It was quite a bit away, but our projected move was this. We expected this pair to consolidate, give us a stop hunt to the bottom side, and start rising in price for that long sustained run. Now, why is that? Well, we had 1, 2, 3 tests at the low of the day or low of the week, and then it returned back down. It was coming close on this Friday. Understanding this pattern, understanding this behavior, and how it plays out gave us the edge because we knew that it was going to come out, consolidate. We set our strike zone right down here for entry for this long sustained run. Let's take a look at what it did. It came out, it gave a slight consolidation, gave that move that we anticipated here to the low of the week, and then began its long sustained run. Now, take a look at these patterns here. This is a pin pattern here. This is a spinning top. This is a doji. So this retest here of the low was our first candle that we started sort of waking up to, we're like, hey, okay, it's in our strike zone. We now see a candle. Second candle here is validation of the first. Spinning top, our third candle, and our highest probability entry was this doji right here. Now, if you had come a little bit late to the party, it gave you a few other opportunities here. Here's a hammer here, which is the fourth candle, and then this fifth candle is another spike candle. It threw a pin down here pretty close to the low before it actually decided to pull away. Now, if you were trading this over a couple of days, you can see consolidation, stop hunt, long sustained run, couple opportunities here for the continuation of the move, and eventually it retraced back down for the reversal.
Although we form our bias on the hourly, and we can start taking a look at where we might want to set strike zones, we always enter on the 15-minute chart. So we're going to take that down a little bit further as we go on with this particular video and break that down for you. But right now we're just giving examples from play number 1, projecting the move. So again, we enter on the 15. We'll show that in a minute.
Okay, the next pair we want to take a look at is AJ. Now we can see, looking back, play 1, the 3 to 5 day look back, what happened with this weekly structure? Well, we can see that it was trending up. The high of the week was set here on Thursday, retested again late Thursday, and finally pulled away to the 200 moving average. Now on Friday, it decided it was going to make its way back up pretty close to this high of the week. It ended slightly below it, so our move was this. We fully expected it to come out in consolidation, throw the stop hunt to the top side, and begin that long sustained run short. Let's take a look and see what happened. Here we go. There's that consolidation phase. Stop hunt to the high side, long sustained run. Now notice here, here's the reversal right here. Again, these pictures were penciled in, these lines were penciled in before this ever even happened. 3 days before it ever happened, we projected these moves. Another example of the weekly structure, we can see here the overall trend in this pair was down. It dropped for several days, came back up, retested this area here at the 200 moving average, gave us another couple of down days. We had price correct up, and then it repeated this low here. Now, taking a look at this overall, if we're able to draw another line in here, doesn't this look like a double bottom? If we were able to put a line here, draw another line back down here, this would be a perfect example of a double bottom. So what's the pattern? It's consolidation, stop hunt, long sustained run. That's exactly what we anticipated here. Consolidation, stop hunt, long sustained run. Consolidation gave us the stop hunt, long sustained run. When you understand play number 1, it makes your life easy. You know where to look on the charts to make these trades, or to actually locate the strike zones and then have it paint the proper candle pattern to make these trades. GBP CHF. Again, we evaluated our situation. We did a 3 to 5 day look back on August the 16th. What was the trend here? Well, overall it was trending up. We had 1, 2, 3 days of rise, followed by a price correction. We felt like, you know what, it hasn't dropped enough. Generally speaking, these pairs are going to go, if it's only gone 1 or 2 days, it's going to continue in that same direction. We really get interested in possible reverses anywhere between 3 and 5 days. That's why the look back is 3 to 5 days. Now, based on what we've seen here, we expected a consolidation, stop hunt to the top side, long sustained run. Now, keep in mind, too, that this is done on a Friday. This is done 3 days before it actually paints out. Let's take a look and see what happened. Came out, gave us some consolidation, stop hunt to the top side, long sustained run. Now keep in mind, this particular pattern, we're talking about it right now, this play on an hourly chart. What we're actually going to do is move this same play to a 15-minute chart. We'll show you exactly how it works in just a moment. Okay, let's take a look at another chart here. Now we can see here that the high was set here, and our anticipated move the previous Friday was a price correction or a short move. So we see that it went short. And remember, play number one is a 3 to 5 day look back. So we're looking back 3 days and we can see, okay, it bottomed out here, it was retesting, and now it's come up and risen. But basically, we only have 2 days of rise. We have a day of rise here, day of rise here. It spent the entire day here in consolidation. Our anticipated move or our projection is consolidation, stop hunt to the bottom side, and a rise in price. And look, here's what happened. It consolidated, gave us a stop hunt, rise in price. Now, I just want to reiterate, we're simply identifying movements right now. We never ever enter on the hourly chart. It's always on a 15-minute chart. And I'm going to show you a little bit deeper exactly what we're talking about in play number two. Play number two, the daily structure. Here are the components of our daily structure or play number two. It's consolidation, followed by a stop hunt, a long sustained run, an opportunity to get in on the continuation of the move, and then the reversal. Here's our consolidation. We get a stop hunt to the top side. We then see a long sustained run. Somewhere on this long sustained run, there's going to be an opportunity for the continuation of the move. There's two purposes for this continuation of the move. The first purpose is for those that came a little bit late to the party. It gives them an opportunity to trade. Helps you be a little bit more efficient with your time. Gives you another opportunity. The second thing that you can use this continuation of the move for is to pile onto your trade. When you know that you're headed the right direction and you want to beef it up and make some more pips or some more money, this is where you would add on to your position size at the continuation of the move. Now, it can fall anywhere from up here down to here. It varies based on each pair. At the end, we see the reversal. This is what it looks like from the bottom side. Consolidation followed by a stop hunt to the bottom side, the long sustained run. The continuation of the move is anywhere from here to here. At the end of this run, we'll see a reversal. Okay, so the components once again, consolidation, stop hunt, long sustained run, continuation move, reversal. Let's now take a look at these and identify them on the chart. Here is our consolidation. Here is our stop hunt, followed by our long sustained run and the reversal. Right here in the center on this particular pair, that was our opportunity right here to get in on the continuation of the move. There are several factors here that we have taught throughout this class, like our strike zones land right here, inside of the stop hunt or down here near the reversal. Keep that in mind. Strike zones are here and here. Okay, let's take a look at another example here. Now, I want you to keep in mind, we've already done play one, our macro check down. Our bias has been set. We know exactly what we're looking for. So now we're looking for play two, which is the daily structure. Here it is, consolidation, stop hunt. Now, I want to point something out. Sometimes it's going to be a deep stop hunt. Other times it's going to be very shallow. You simply have to develop your kindergarten eyes to see this play. Once again, consolidation, stop hunt, long sustained run, reversal. Now, there's an opportunity, a couple opportunities here for the continuation of the move. Right here and right here. And just as a reminder, I want to let you know that we've already done our macro check down. We already know in this case our bias was short. It threw a bunch of candle patterns that we know and love here, these pins through the 800. The trade was grabbed here, just a few pips off the high, and paid out in 2 candles.
I want to point out something that hopefully all of you have noticed, and if you haven't noticed, hopefully you'll take notice of it in these future slides, and that the consolidation and the stop hunt and the trend run and the reversal, they all come at different times, and they're all different amounts of length in time or duration of time. It doesn't pan out at the exact same time every single day. It doesn't happen in the same color box or at the same EMA. However, the structure, the principle of the play does not change. It happens at some point in time in these pairs. It's learning to recognize the different components and their different elements that's going to allow you to master the market maker's playbook.
Also, if you're thinking to yourself, hey, this looks exactly like the structure on the 1 hour, you're right. The structure is the same on all time compressions. The structure, whether you're looking at a 15-minute chart, a 1 hour chart, a 4 hour chart, or a monthly chart, is consolidation, stop hunt, sustained run, reversal, with an opportunity for the continuation somewhere over the long sustained run.
Let's take a look now at another example. We can see here, here's our consolidation. This time the stop hunt is shallow. Last pair it was really deep. This is a shallow stop hunt, long sustained run, reversal. Now note here on this chart, this is one from market checkdown, we had already identified, before any of this painted out, we identified our strike zone as being here. We got a retest of the low here with this doji pattern, and this trade panned out very quickly. 3 candles later, we were done. Let's take a look at the next example. Here's our tight consolidation here. Very small stop hunt, long sustained run. Now, I've had this question more than once. When you're first learning how to trade, this blue box is almost like training wheels. We like to see this box less than 50 pips in most cases. Why is that? Because we're simply trying to give you training wheels to identify this pattern, this consolidation, the stop hunt, the long sustained run, the reversal. As you develop your 2020 chart vision, these boxes, as was previously stated, do not matter. The ADR really doesn't matter. As long as this pattern plays out, we're going to use it and take advantage of it. In this case, again, consolidation, shallow stop hunt, long sustained run, reversal. They gave us 1, 2, 3 opportunities with 3 sets of railroad tracks to get into this trade. Note also, price is rising here in our candles, but yet has fallen flat here in TDI. We're at the extreme overbought level as well. Again, it's a culmination of things helping us to understand when they're ready to roll the market over.
That was an excellent point that my father made about the boxes. All the stuff on our chart is there to help you identify the components of the structure. However, if they're getting in your way, feel free to take them off. Make your chart with whatever you want on it that helps you recognize the trades, the setups, the components of the structure. We've just labeled this stuff on the chart to make it easier as you are first learning.
Here's an example of the exact same structure. This time we're looking at the commodity markets. Here's our consolidation. Here's our stop hunt. They gave us a couple of shots. That's another thing. Sometimes they'll give you more than one shot at the stop hunt. It's okay. As long as we're recognizing the pattern, it's okay. 2 shots at the stop hunt, long sustained run. Here's the reversal. Opportunity for the continuation is in here. Now, we took a little bit of heat, but it corrected nice and paid out well. Okay, let's take a look at another example here. Now, I want to point something out to you. These boxes are painted in certain areas, and these are the highest probability areas that we see where you're going to see consolidation. Most often, the consolidation will come in this blue box. The stop hunt will come inside of one of these 2 gray boxes. The long sustained run often happens inside of this box. The reversal often happens here. It doesn't pan out every time, but we simply wanted to highlight those areas to help you understand and to help you learn to identify this pattern. Here it is, offset just a little bit. Here's the consolidation, the deep stop hunt, the long sustained run, and the reversal, with opportunities here, here, and here for the continuation of the move. Now, notice here where the strike zone was set. This is a dark cloud cover, beautifully painted. We have TDI outside the volatility band, and we also have it at the extreme overbought area. This was a beautiful trade taken by one of our traders.
I just want to note that we're talking a lot about those boxes and why we have them there. If you were to take this chart and shift it over to the right about 1 inch, I want you to see how perfectly this lines up. This consolidation would be right inside this blue box. This stop hunt would be right inside this gray box. This long sustained run would lead you right into this blue box, and the reversal would come right down into that red box. That's why we put them there, is so that when you're learning to see the pattern, it's highlighted well for you when these line up. And when these trades line up in these boxes, they are high probability trades. So when you're first learning these methods, if you simply wait for the trades to line up in these boxes, your win percentage is going to be super high.
Okay, let's take a look at another example. This one lines up quite a bit closer. So we see here's the consolidation inside of our blue box. The stop hunt is here, not quite as high, but we can see here that we had 2 shots at the 200 EMA, followed by the long sustained run, and then we see a reversal at the end. So consolidation, this time 2 hits for the false move or the stop hunt, long sustained run, reversed out here. Notice again where the strike zone was set. Right here at the low, we've got a couple other components telling us, take a look here at TDI. It's extremely oversold. It's outside the volatility band here. The ADR has been met. This is a beautiful setup. Our next chart is an example of the pattern displayed in the stock market. We can see here, here's our consolidation phase, here's the stop hunt, here's the long sustained run, here's the price correction or reversal, with an opportunity right here for the continuation of the move. Now remember, these patterns play out in stocks, commodities, futures, precious metals, and so on. Just learn to identify this pattern. Okay, let's take another look here. We have the consolidation phase, the stop hunt, the long sustained run, and the reversal. Opportunities in here for the continuation of the move. Now this is an example of the pattern or the daily structure lining up perfectly inside of these boxes. Here's the consolidation, here's the stop hunt inside of this blue box, here's the long sustained run, and the reversal starts here in this blue box, pins it again here, and then corrects price here. Let's take a look at another example. Here's the consolidation phase, the stop hunt, the long sustained run, the reversal. Now remember, we set our strike zones here at the stop hunt and here at the reversal point. Next we're going to take a look at a chart from the stock market once again, Deutsche Bank. Here's the consolidation phase. The stop hunt is shallow. Long sustained run, reversal, with an opportunity right here in the middle this time for the continuation of the move. Do you see how you can benefit trading this pattern in all markets? It's available. It happens over and over. Learn to recognize it. Here is another picture-perfect example of the pattern playing out inside of our boxes. Here's our consolidation. Here's our stop hunt. Here's our long sustained run. Here's the reversal. Notice how picture-perfect this is. These candles painted right inside of this box and price corrected exactly inside of this box. As Diana mentioned, if you simply just trade this pattern inside of these boxes, your win rate is going to be very, very high. You might not make a whole lot of trades per month, but your success rate is going to be very high. And once again, just to help you learn, we've painted these boxes here to sort of highlight those areas. The consolidation generally happens inside the blue box. The stop hunt is outside the blue box, somewhere between 25 and 50 pips, either to the top side in this light gray box or to the bottom side in this light gray box. The long sustained run often occurs here or begins here in this blue box. And the New York reversal often starts inside of this box. Let's now take a look at a bear chart and see if we can identify this pattern. Okay, here's the consolidation phase here. Stop hunt, long sustained run, reversal. Here's the opportunity for the continuation. And here's what it looks like again, picture perfect with our boxes. The consolidation, stop hunt, long sustained run, reversal, opportunity for the continuation right in the middle here. Okay, so number one, just to recap, is our weekly structure. It's a 3 to 5 day look back in activity or trend. We also call it our macro checkdown. This helps us determine our directional bias, helps us highlight high probability pairs that may be in the process of forming strike zones. Play number 2 is our daily structure, which consists of the consolidation, stop hunt, long sustained run, continuation move, and the reversal. Here's a visual recap of what it looks like. Again, we're looking for the last 3 to 5 days in activity. We can see here the high, actually the lowest set over here, midweek reversal or highest point on the chart, also known as our anchor or our peak was set here. We had a little bit of a retest, and then price faded away here. Let's now take play number 2 and highlight it inside of our weekly structure. Follow me here. Here's the consolidation phase. Here's the stop hunt. Here's the long sustained run. Here's the price correction. Consolidation, stop hunt, long sustained run, correction. Consolidation, stop hunt, long sustained run. This time it was a small correction. Consolidation, stop hunt, long sustained run, correction or reversal. And then taking it short. Consolidation, stop hunt, long sustained run, reversal. Consolidation, stop hunt, long sustained run, reversal. Notice when the pattern plays out, when these pairs are behaving, it's very easy to identify not only the weekly structure, but the daily structure.
I just want to interrupt and take us on a little side journey here, a little tangent, because this chart paints a perfect underlying factor for our components of the structure, and that would be correction. Taking a look over here, we see that this was obviously the peak formation low, our point of reversal. It takes off with 1 day of rise and all of a sudden turns back around and paints back to that 200 EMA. Remember, one of the things that we talked about is correction will often paint back to the 200 EMA. We can see that we are still in an uptrend even though prices move down, as we have the 50 above the 200, the 5 and the 13 above the 50. The 13 never breaks below the 50. However, the 5 does temporarily, but we can tell that this is a sign of correction, not a sign of a reversal. Thus, we know that we still have a couple more days of rise out of this pair before we get that true reversal.
This is also a beautiful example of fundamental analysis, because the underlying factor to the underlying factor, the cause of that was a news announcement that caused a surge in momentum in price, which caused it to have to consolidate, take a break, correct, and then go back into its regular structural pattern. So again, fundamental analysis caused the underlying factor of correction in our pattern.
Let's take a look once again at a picture-perfect example here. And again, these are high probability trades here. We've painted these boxes here to help you understand this pattern. Here's the consolidation, the stop hunt, the long sustained run, and the reversal, with an opportunity right here in the middle for the continuation of the move. Okay, before we move on to our third and final play, we want to recap play number 1, which is our weekly structure. We can see here that we had several days of drop, followed by a move up, and then a retest of the low of the week. Doing our 5-day look back, we see 1, 2, 3 days of drop. 3 days of rise here, but we had several days of drop here. Again, this is picture perfect. These are the types of patterns we're looking for. We're not looking for a bunch of snow or a bunch of noise all over the chart. We're simply looking for pairs that behave. Now, inside of that behavior, we can recognize play number 2, which is our daily structure. It's the consolidation. It's the stop hunt, followed by the long sustained run and the reversal, with opportunities somewhere in the middle for the continuation of the move. Our third and final play, the strike zone and the formation. Now, just as a reminder, a strike zone is 3 or more indicators lining up on or near one another to determine the highest probability or hot price point on the chart. Okay, just as a reminder, we've already gone through play 1, which is our weekly structure. I'm going to now identify play 2 for you, which is the consolidation, the stop hunt, the long sustained run. The next thing we're doing is we're looking for correction, but play 3 is actually our strike zone. So we need to identify exactly where the strike zone is and then what candle pattern is going to pan out. Now, in addition to our long sustained run, note that there are several opportunities here. There's a couple opportunities to get in on the continuation of the move.
Just quickly, want to point out that the strike zone was drawn in at the New York reversal. You could definitely draw in a strike zone down here, but for this particular example, the strike zone was drawn in at the New York reversal. And that just depends. Where you're drawing your strike zones just depends on when you come to the terminal, when you trade. That's why this is play number 3, which is drawing out the strike zones. You come to the terminal when you can get there, and you look back. Play number 1, your macro checkdown, form your bias. Play number 2, the daily structure. And then play number 3, you mark your strike zone.
Okay, let's take a look at our next example here. Again, we have the consolidation here, small stop hunt, long sustained run, and what we're looking for here is our strike zone. What do we have? We have a high of the day set here. Later in the day, it hits that same high, and so our strike zone was set somewhere over in here. You can see that on this particular trade, they threw this pattern slightly above the high of the day, right here and here. And as noted here, it took a little bit of time for this particular trade to pan out, but it paid out over the course of about 2 hours. Now, just as a side note, notice how price is climbing here, yet TDI is signaling us that price is going to correct. Note, we identified our strike zone, and then we used our candle formation to take this trade short. Okay, taking a look at our next example, we can see here was the consolidation phase, the long sustained run. Now, again, we're coming to the terminal somewhere over in here. So our strike zone was identified here. It came back, maybe an hour and a half later, but it never actually painted that reversal signal. So we sat on it and we waited. Once it actually painted play number 3, so it's the first of all the strike zone, which we identified. Second half of it is the candle pattern. The trade was offered up here with these pins at the low of the day. Generally speaking, on a New York reversal, we're going to take it back to the 50 moving average or slightly below it in this case. Let's take a look at another example here. Play number 1 has already been determined. We have our bias coming into this. Play number 2 is the daily structure, which is as follows. Consolidation, stop hunt, long sustained run. Now in this case, we're looking for a reversal. The bias is short. Opportunity for the continuation of the move is right here. Now, this one fell slightly below the ADR high and also the previous day high. But what do we have here that tells us there's a good trade here? High was set here. It worked this area, came back, pinned the high, came back and pinned it a third time before it actually corrected price short. Note also that here the TDI is at the extreme overbought area. It's outside the volatility band. These are components that are telling us this is setting up to change direction. And just as a final note, notice how perfect this lined up inside of our boxes. Here's the consolidation, stop hunt here to the blue box, long sustained run. The beginnings of the reversal was at the end of this box. It finished off about an hour later. Okay, let's take a look at another chart here. Play 1, weekly structure. Play 2, daily structure, and we can see that it's already painted out. Play 3, we're looking for the strike zone. It was identified here at M0, at the low of the day. We also note that our TDI is at the extremely oversold area. It's outside the volatility band. The second half of play 3 was the candle pattern. We can see that it painted that we liked. It was an easy trade. We never took any heat, and it paid out in about 2 hours. Note here how it also painted right inside the boxes. Everything was just like we planned. That's why we set these boxes up this way, to assist you in seeing this pattern. Let's take a look at another example with EJ here. Play 1, weekly structure. Play 2, we can see here, consolidation, the long run. Play 3, we're simply looking for the pattern. We've identified our strike zone here. We're looking for our retest, which we got. This was an easy trade for short. Let's now take a look at our final example. Play number 1, the weekly structure, has painted out. Play number 2, we can see it here. The consolidation, the stop hunt, the long sustained run. Play number 3 is simply our strike zone, which has been identified here. ADR high, M4 on the pivots, TDI. We're simply looking for the candle pattern, which is painted here, and in 4 candles, it's paid out. Do you see how you can benefit from understanding these plays? Play number 1, the weekly structure. Play number 2, the daily structure. Play number 3, the candle formations and our strike zones. We have to have these strike zones first identified, and finally we look for the candle patterns to paint inside of them to give us the optimum or best trades that are available. Okay, let's recap the market maker's playbook. Play number 1 is the weekly structure, that 3 to 5 day look back, helping us determine our directional bias. Play number 2 is our daily structure, consolidation, the stop hunt, long sustained move, the continuation of the move, and finally the reversal. Play number 3, identify the strike zone and the candle formation. Remember, you need to identify the candle formation inside the strike zone.